Hi, everyone. Thanks for coming out. So the Finance 2.0 panel, this morning we've heard quite a lot about just how far we've come in 11 years, from really nothing to something pretty big, pretty meaningful. I think in this panel, what we're going to try to do is really think about the next 11 years. And I think the biggest thing that's been missing in the space is really use cases and adoption. So you have a lot of the infrastructure in place. There's a lot of interest, a lot of venture money. Trading and speculation is a major use case to date. But I think what we're going to try to dig in here is with 4 people who are building really powerful companies that aim to bring cryptocurrency and blockchain into people's homes and into institutions. So I'll let everyone give a little bit of an introduction of themselves and what they're working on, and then we'll really drill into the use cases of crypto. Start us off, Tyler.
Oh, sure. Hey, everyone. I'm Tyler Spalding. I'm the co-founder and CEO of Flexa. So we're a new payments network that allows any cryptocurrencies to be spendable in stores in real time and with no fees, no volatility, and no fraud. And we'll also be rolling that out online as well. So basically a new payment network to let crypto be usable as money and payments.
I'm Tom Chippis. I'm the CEO of ErisX. ErisX is a CFTC-regulated spot and commodities exchange for cryptocurrencies. I think couldn't have had a better introduction than Chairman Giancarlo yesterday. We are focused on working with intermediaries and helping people to manage risk in the crypto space by launching physically delivered futures later this year. And it's a company with a 7-year track record, operating a very clean regulatory platform. And we're really focused on integrating and making crypto available to a wider audience via those intermediaries that people know and utilize today, both retail and institutional.
Hey guys, I'm Michael Dunworth. I'm co-founder and CEO of Wire. Wire is very much a fiat to crypto solution where we started in 2013, and the problem we had was how do we get to market as fast as possible? And one of the biggest challenges that every team faces is the regulatory ambiguity and the heavy resource constraints when it comes to banking partnerships and liquidity sources. And so what we did was we spent sort of 4 or 5 years doing that ourselves, and now we're fully regulated in North America, Australia, Hong Kong, and other jurisdictions. And we wrap that up into a developer kit, and we deploy it to all the developers building amazing applications around the world. So.
Great. Good morning, everyone. My name is Ethan Beard. I work at Ripple. I'm sure many of you are familiar with Ripple. Ripple's mission is really to enable the Internet of Value, which is to help value and money move as easily as data does today. And we accomplish this in a variety of different manners. One of the primary ways is through our enterprise product for financial institutions called RippleNet. The team that I lead is a team called Spring, which is really looking to enable the Internet of Value for developers writ large. So we have an open platform to really help developers take advantage of cryptocurrencies to enable money in their apps, regardless of what that application is.
Awesome. So I think of everyone here, Tyler, you've been involved for 9 years now in Bitcoin, so almost Satoshi, could be, who knows. But what have you seen currently today as the strongest use case, and how have you seen that evolution come about?
So for me, it's payments, 100% payments. For me, it's been that way ever since. So I have a natural bias as well. So I've been now in mobile payments and started and sold companies for the past at least 10 years in mobile payments. So I'm very focused. I know you can use potentially a blockchain or other permissionless chains or other technologies for other things, but for me, payments is just this unbelievable use case and value. You heard even earlier, Wences talked about these legacy institutions and the lack of innovation around how these companies have approached payments in general. And you even then saw the previous presentation around web browsers. And we looked at or heard Andreessen, Marc Andreessen has talked about the cardinal sin of the internet, right? Have you guys heard that analogy? The cardinal sin, they said the thing they had done wrong was not include payments in web browsers. So there was no native digital payments online. And so they wanted to do that, by the way, so they knew this. But when they approached the banks to integrate this, they're like, well, why would we ever do this? Why would we include digital payments online? No one's going to use the web to buy something, right? And that was the attitude that banks had in the 90s. And so now it's evolved, right, into a model that Brave, right, is counteracting, where it's all just like Facebook and Google and paying for advertising and monetizing users and things like that. And so that's what we've got today. And then even earlier, Pete was mentioning from Fortress. That was actually really riling me up, so thank you for that little talk there, when he was talking about interchange and these payment networks, payment card networks, and the interchange costs for just being able to transmit money. He also left out that even in the US alone, there's up to $20 billion with a B of just fraud cost due to fraud associated with payment cards. And so when you look at that system of where it's evolved, I think kind of the freedom of choice and being able to use cryptocurrencies in a totally efficient manner, I think it's inevitable that that will start to replace that system.
So how's Flexa solving that problem?
Oh, really good question. A lot easier said than done. But basically, through our experience, we're working now with merchants to work with their existing hardware, existing software, to basically now build a network that allows the exchange capabilities, all the kind of compliance capabilities, whether it's KYC, LD, AML practices, being able to understand how an asset can kind of move through a system, no volatility, handling all of that within our network, as well as all the technical complexity around security, to where a merchant now can accept cryptocurrencies as literally the fastest and cheapest payment method, literally above anything else that they have, using all of their existing infrastructure by just giving us some very novel permissions, and we just make it very easy. And then the other thing for us is that we're a B2B company, so this is all a network, and that any wallet can have this functionality, so that's then hopefully now where the consumer adoption will come from too.
Got it. And Ethan, in some ways, Ripple is going after a similar problem set. Kind of how would you compare and contrast, and is this also what you think is the future use case of crypto?
Yeah, so generally when I think there's lots of use cases for blockchain. I think when I look at cryptocurrencies, to me it looks like money. When I look at the use cases for money, there's kind of two things you can do with it. You can either spend it or not spend it. Those are kind of your only options with the money that you have. So which I generally lump into, if you're going to spend it, that's payments, which I think is a tremendous opportunity, which we can talk more about. And if you're not going to spend it, I think it's collateral of some sort. It's, how can you build it into a loan product, a savings product, something that's a building block for a future or derivative of forward, something like that. In the payment space, which is a lot of where we're focused on broadly at Ripple and within Spring, the entire world of payments is really built on these very old and antiquated systems that is basically built on top of a series of debits and credits. So I just sent someone to Venmo literally 2 days ago. It cost me $25 to send someone to Venmo them money. They're in the United States. They don't live very far away. And the reason that is because basically that transaction was me giving an IOU to my credit card company, who's giving an IOU to Venmo, and Venmo's giving an IOU to my friend, who's eventually going to get the money in some form or another. But the number of IOUs that's passed around, it's basically like we're passing around all this credit. And as everybody knows, credit is it's pretty complicated, it's quite expensive, and there's a lot of legal terms and complicated aspects to it, which brings all these middlemen in place and really makes payments completely busted. It should not cost me $20 to change a database entry in Venmo's account system. That's literally all they did is just move that money from me to another person. Whereas we look at cryptocurrencies, we focus a lot on XRP, but this is similar for many of them. It's basically free for me to send that XRP to someone. And so when we look at what's going on in payments, we think there's an opportunity to really rebuild the entire world of payments, the entire way in which money moves from the bottom up. So when we look at Spring, we're building a developer platform to make it easier for developers to tap into this technology. We often look out at technologies like Stripe, which is really a developer platform to be able to move money. They kind of have come from the top down and said, how do we take this existing broken system, wrap it up in a really great API that makes it very simple for a developer to build on, but you're still stuck with a lot of these old systems in place. And what we're trying to do is say, okay, there's a new piece of technology, which are these cryptocurrencies. How can we start at the bottom, make these easier and easier to build? And eventually we want to be in a world where whether it's companies like Flexa or whether it's companies like Stripe, they're able to simply tap into the power of a cryptocurrency to take advantage of the characteristics of it, the speed and the inexpensiveness with which you can move it.
What's been the hardest part of doing that? Why isn't Ripple widely used by all payment providers today?
So we started Spring about a year ago, really looking to build an ecosystem around XRP, and there was just two of us on the team, and since there was just 2 of us on the team, we started out just making investments, doing strategic partnerships, and really just talking to a lot of people, a number of people that are in this room. We've made a bunch of investments in partnerships, I think over 20 companies. We've deployed and committed about $500 million. One of the things that we kept finding as we were out there talking to the world is like, it's actually really hard to build on cryptocurrency. Like if you're a developer and you actually want to just like, hey, I want to move some Bitcoin, it's remarkably challenging. I mean, think how hard it is. I'm sure everyone in this room has tried to tell a friend or a relative, like, go buy some Bitcoin. It's actually pretty hard to buy Bitcoin. Like shockingly hard. It's much easier to get money like fiat than anything else. And so I think one of the big problems is like, it's just hard to build on these technologies. When we look at the world of developers, we think there's about 5,000 to 10,000 blockchain developers on the planet today that are like building specifically on crypto. There's about 20 million or 25 million developers, people who get paid to write code. And so we think that there's a tremendous opportunity to address all the rest of the developers. Everybody's touching money, right? Anyone who's building an app is using money. Any service that you're putting online is using money. But it's really hard for them to say, like, how can I tap into blockchain and into cryptocurrencies? And so for us, it's a lot of it is making it much simpler to build on.
So one part is definitely building out the infrastructure, which you guys are focused on. But the other layer that has to come in is, of course, adoption and use cases. So I know, Tom, you've spent a lot of time at different institutions, running them, leading them. You now have an awesome platform that's targeting and working with them. You know, what's sort of the holdback for more institutions to come in or more mass retail to come in? And have you been seeing that evolution?
It's not quite as fun a question like Wences gets about what's the price of Bitcoin in 10 years' time. But I think when are the institutions coming is probably the thing that we get asked the most, only because of how ErisX is approaching the market. You know, I can't thank you enough, Dan, for having Chris here yesterday. Like it completely lays out the use case for what we're trying to do. Specifically, institutions have a lot of considerations. So I think what Mark's referring to, I ran quantitative prime services for Barclays globally for 5 years, a large systematic trading and financing business. I was at Citadel for a few years, and I've seen a lot of things in the institutional space. And one thing that we might not like to hear, but today, here and now, even at the market cap of Home Depot, it's sort of irrelevant to the P&L of a very large institutional sell-side firm, a Morgan Stanley, a JP Morgan, a Goldman Sachs, a Citi, what have you. Could you imagine if BlackRock, Vanguard, PIMCO, Fidelity just said, oh, we're going to put 5% of our assets into it? I mean, everyone here might love it because the price of Bitcoin would have to react to that, but it's just not practical for them to do that in the short term. So I think that the institutions are coming needs to be asked slightly differently. And from our perspective, a lot of the things that Commissioner Giancarlo mentioned about intermediaries are super important. If I run a large global macro fund and I want to invest in digital commodities, which is what we specialize in at ErisX, we list digital commodities on our market, I need to be able to do that with the providers already used today. I'm probably trading the commodity. I want to trade a derivative, so we have both those on ErisX. I need to be able to integrate that with other things that I do because I have a broad portfolio that has different expressions of risk and alpha and what have you. And today, that integration can't exist in the fully integrated models that we have. The retail ethos of crypto has sort of created this dynamic where the marketplace where I go to buy crypto is the broker, the exchange. It might be trading on that market. It could be doing all sorts of other things. We as individuals can't go become a member of NASDAQ. We can't go become a direct member of the London Stock Exchange. That's not how it works in other asset classes. So the intermediaries are necessary. And that's been the focus at ErisX. We are intermediary friendly, not just in word and marketing, but we have built the operational processes and technology. We have created a rate card that encourages their participation. Whether you're an investor or not, the terms of service are the same. We've created all the fundamental components necessary for those intermediaries to come in. And when they come in, then we'll enable all these other folks that I think are being referred to by, where are the institutions when you say who's the institutions.
So Adam White at BAC talks about capital I institutions like Capital Group or Wellington, and then lowercase I institutions like Bitwise or Pantera, where it's not quite retail or prosumer. How would you sort of categorize the different groups of institutions? And today, who would you put into the lowercase I category?
Yeah, I mean, I guess a taxonomy is always very, very helpful. And I think I rattled off some of the capital I ones, and it should have included Cap Group or in California, obviously, given their size. But I would say we look at it more as, from our perspective, we're building a true commodities market. So I would categorize it slightly differently. Whether your AUM matters or not, I think is a different metric to look at, a different piece of data. We look at producers. So are you mining cryptocurrency? If so, you're really not that different from someone who's extracting a precious metal from the earth, or doing something in the farming side where you're actually generating and growing commodities. So you're a producer. When there are producers, you tend to also need speculators, and you need hedgers, and you bring in a whole variety of people. So if we look today to things such as gold or grain or oil or what have you, we have all those types of market participants. That's how we look at the space, and within there, you can have large and small. I think the attribute of size could be an impediment right now for the reasons I laid out. Over the long term, I don't believe it is. But right now, what you're tending to see is participation and interest from smaller AUM institutions, but it's really about bringing institutions of those different stripes I described together in a place where they can trade the commodity, hedge the future, and really do the things they need to do to manage the risk in their business.
Yeah, so participation and adoption and community are incredibly important, obviously, on the protocol layer as well, where you need both the right tech and the right developer community. And there too, in terms of adoption, we've seen a lot of growth, but there are many questions about what the future is. So this question is more for Michael around, what do you see as the most exciting DeFi applications? And the institutional side gets a lot of heat for not having maybe as much adoption yet, but you could say the same thing for many of the DeFi projects out there. What are you most excited about today, and how do you think that'll look in the future?
I think it's really interesting. The institutional side is, at the end of the day, they are not stupid. They're obviously really intelligent in what they do, and what they do is make money. And when there's an opportunity to make money, they will be there before everyone else. And I think what we saw, for context, Wire is like a fiat to crypto, so that means we require liquidity. If we require liquidity, it means we've got to be trading and have a lot of volume. So when we work with the large trade desks or the institutions, many of them in the end of 2017, start of 2018, they'd all been watching BitMEX and Coinbase making $3 to $4 million a day. And they are like, there's only so far they can go before they sort of, the boss starts saying, why are we not making that money? And so they all set up actual desks and shops ready to go for providing, high net wealth individuals access to this asset class. But then the party stopped and they just missed it. And then now it's back to business as usual. When I look at what's going to happen, in the future, I think DeFi, if anyone's not familiar with the term DeFi, it means decentralized finance. So, a bank, it's got payment processing, mortgages, lending, savings. It constructs this way for a bank to hold capital and put that capital to work to grow that capital. And, the polar opposite of that is reconstructing it from the ground up, similar to what Ethan said before, which is we're not, Revolut or TransferWise, which is white labeling Barclays and getting, a scaled pricing tier, which makes it more affordable and more sexy and more consumer friendly. It really is building it from the ground up, which means creating liquidity. And liquidity, in my opinion, this is a money game. It's all about value transfer. Liquidity is the user experience. And if I'm going to trade, $1 million worth of capital, or I want a loan, that's got to come at the price of liquidity. So the more slippage I'm incurring, the more I am basically going to get charged fees, or it looks as a less valuable product. So what we'll see is liquidity rule the roost. Right now, that's probably MakerDAO and Compound. They're lending and borrowing platforms that are totally native to the protocols of Ethereum, and they'll expand to other assets as well. I think it's really important, though, to ask the question, what adds value? Because, I definitely understand, I can empathize with, talking about $25 payment from Venmo. That's not really, that's very expensive, obviously. And we have our problems here, sitting in San Francisco, where we say, no, we don't want 4 clicks, we want 2 clicks. And that's what we're expecting, because Robinhood's got 2 clicks. But if you look at, let's say, MakerDAO, which does lending, collateralized lending, you put down 1.5, X, you can withdraw up to 1X. So we think that's crazy because we're getting credit cards shoved in our face for nothing down and all that sort of stuff. But imagine if you're in another country where we're not as fortunate as what we have today here in this infrastructure. I think that's really powerful. So I think it's sort of like a value is in the eye of the beholder situation where once everyone catches wind of it, it's just a game of, you can't fight time basically, unfortunately. So as long as we're working towards that.
Do you think the DeFi use case, you kind of referenced this, might be stronger in a country with more inflation or in a place that's underbanked? Or is the US kind of the leader in technology, but maybe somewhere else will be the leader in adoption? How do you see that play out?
I think, I definitely agree. I think, look, the US is, the problem it has is it doesn't have as many problems to solve, really. And so if you look at DeFi, generally speaking, what it's going to do is two things. One, it's going to flood the market with competition in the already established market. So now, you know, we say at Wire, it used to take 6 months to go to market. Now we say it takes 6 hours to go to market. And if there's people like us pumping our stack into code and then giving it to everyone at, you know, for nothing, that is just going to accelerate this velocity of failing. And the faster everyone fails, iterates, rinse, repeat, that flywheel, once that catches, that means this market gets hyper competitive where there's, you know, 100 Robinhoods, you know, 10 different Robinhoods starting a day, or, you know, Revolut, or whatever the sort of the challenger bank be. And that seeps back into, you know, other people's countries that they're from. I think the predominant amount of entrepreneurs, you know, in Silicon Valley, I think it's like over 60% are foreign born. And that means there's probably going to be some capacity of repatriation of use cases and things like that. So.
And really for all of you guys, where do you see DeFi sort of competing maybe with your businesses or with centralized finance? And have you guys thought of how to incorporate it? Is it a plus to your platforms? Is it a threat? It would be interesting to kind of hear how those two things intermingle. Maybe Tyler,
I guess,
start with you.
yeah, I would comment to that. In that a lot of what we're doing, so I mentioned that we built this new network that now allows these new efficiencies in terms of zero fraud, the cheapest payment method. If we do that, let's say we do it and all we're doing is just replacing all the legacy infrastructure with now a new digital system with the exact same sort of capital structure. It looks exactly the same, and now it's just a new entity that's been able to seek rent and make fees in the exact same exploitative way, right? That doesn't get us really anywhere. And so we've actually embraced this and cryptocurrencies and just like token economics itself to create a new model to where, so I'm actually a really strong believer, very whole belief of a good token model is better than any business model. And I really do believe this, in that, so within our system now, we have a utility token that people use as collateral within the system. And so this is all behind the scenes too. Users don't interact with any of this. It's a developer tool. It's all B2B focused. And that all the small fees that we do collect in the system all go to the people providing the collateral. So it does sound really crazy at first, but Flexa as an entity has no business model. We don't make any money whatsoever, and we don't really plan on doing it. We've created a token economy where we find all the value is accrued within the token and within the network itself. So if you participate in the network and use the network, you're the one that then becomes enriched. And we think that that is a different way of thinking about, like, again, centralized finance and what this, so for us to, we have these massive, you know, aspirations, right? I'm sitting here on stage, this really small company say, we're gonna take on these huge legacy payment networks and these $100 billion companies, and we have something that's so much better that can be interesting. Well, we won't survive unless we actually can compete in a way that they can't compete against us, right? They can't take all of their value and distribute it all to their users. They're the ones that are worth hundreds of billions of dollars and their stockholders and their entities. And so if we now, for the first time, crypto enables us to do this. This is something we couldn't do 5 years ago. This is not just an opportunity of, oh, we can go to an ICO and sell some tokens and, you know, kind of figure out some sidecar business or something, right, to tie all that together. For us, it's been fundamental from the very beginning of something that this type of decentralized system and blockchain technology enables us to do this for the first time ever, which is why we've structured it this way. And we believe it has the potential now to outcompete within, again, our narrow focus, right? I am very much speaking for this around payments. It's not just a one-size-fits-all, but within our world, we think this is the path to how you actually can shake the foundation there and actually make really meaningful change.
And obviously that's a massive vision, and maybe we're just getting started, but if this is a 9-inning baseball game, which inning are we in this vision of replacing payments and infrastructure and crypto touching the lives of billions of people maybe?
We'd probably be in like the top of the first inning, really, in my opinion anyway. A part of that is too, when you think about like cryptocurrencies and Bitcoin, for instance, right? There's even a philosophical angle there. Is like, what do people use Bitcoin for? I mean, right now, as we're all very well familiar, it's 99% speculation, if not higher, right? When people say that they have Bitcoin, they say, I've invested in Bitcoin, or I own Bitcoin. There aren't as many people going around saying, I spend Bitcoin all the time, or I use Bitcoin as a payment utility, because you could argue that even though it might have started out that way or had ambitions around that, like, it's an asset that has a limited supply that goes up in value. The more people use it, the more it becomes worth. Like, that's not what money does, right? When you have cash in your pocket, if you have a $10 bill in your pocket, you don't expect it to be worth $100 a year from now. In fact, you have the exact opposite perspective, and that it's going to be worth less due to inflation. So there's more utility in that money. And so I think that other tokens, other projects, other cryptocurrencies, XRP might end up being one, right? Where people actually have the utility of spending. It's designed for spending. It has the user incentives for spending. It might have other ways to, when you use it, maybe you earn something, right? To compete against all these, institutionalized credit card cashback models and things like that. I think that is all starting to happen. And for better or worse, there's a lot, I can argue on so many different sides around Libra, right? A lot of strong opinions on that. That is the sort of thing though. Let's assume that Libra becomes successful, right? So strip away everything else being Facebook or anything else. Now you have 1 billion people that have crypto that don't even know it and can now use it natively within apps to purchase things. Like, that becomes really powerful. And so I see all of that being totally inevitable, purely based on selfishness and cost structure, right? If something costs 1/1000th of what the other system is, people are going to use it and people are going to adopt it, and big businesses are going to adopt it and they're going to use it. And I think that that's just getting started now. So yeah, we're very, very early.
Yeah, I would agree. I think maybe second inning, maybe we passed first since we had a big downturn in prices. But I think we are at the very early stages. And I think if we're talking about finance, like, to me, finance means money. I think everyone kind of agrees with that. Everyone in the world does not think of money as cryptocurrency, does not think of it as Bitcoin, doesn't think of it as XRP, or choose your favorite cryptocurrency. At best, they think of it as an investment. At worst, they just have never even heard of it. But like, I get paid in fiat. I pay my bills in fiat. I bet most of you pay your bills in fiat. That's how everybody works. And so in many ways, I think when we're looking at the future, be it payments or be it any other type of financial product, you need to touch the world of fiat, right? Which is, I'm preaching to the choir here with Michael. But we think, and one of the reasons why we're pushing on things like Interledger Protocol, which is really an open standard for moving any type of payment, is because you need to be able to figure out how to move money, right? Not how to move crypto, not how to use crypto, but how to use money. And money means fiat. And so figuring out those bridges and figuring out how do you actually tap into cryptocurrency in the proper place. And so what we've done with RippleNet is allow banks to actually bridge through XRP so that they can have on-demand liquidity. So they don't have to leave piles of fiat hanging around in other countries just in case they need fiat. They can tap into the digital asset markets and get fiat in real time. And similarly, what we're doing with Spring with an open platform is really using Interledger to say, just run every payment through Interledger. You can run any fiat you want. You can run any payment you want. It looks like TCP/IP. It packetizes a payment. It's just like very, very simple. And we think that if something like that is broadly adopted, it will be much easier to be able to tap into something like XRP to be at the appropriate place. It may not be me paying my utility bill in XRP. I think that's probably a long ways off. Now, I may pay it in US dollars because I live in America, but somewhere in that payment flow, which today goes through a lot of different middlemen, there's very likely we can cut out a lot of those middlemen and actually reduce liquidity needs for a lot of the players in there by tapping into something like XRP to be able to speed that up.
So I'd still be paying my bill in USD, but I go to that company because their fees are 1/100th of everyone else.
The company's
and they can
using
only
Flexa,
do that because
right?
They've got a lower cost base because of their infrastructure.
And how do you view JP Morgan Coin or other banks or large technology companies? You know, Libra was obviously mentioned, that are also creating payment systems. How does Ripple work in that ecosystem? Is it good for you guys? Is it a competitor?
Well, so a number of financial institutions are our customers, and we work with them to solve cross-border payments and global payments. That's very different from like what's going on kind of in their crypto efforts, I would say. I mean, stablecoins to me are really fascinating. I have been looking at them for a long time and still don't know if I have a perfect perspective on them. They're a liability, right? So like by definition, like a JPM coin is a liability that like JPM now owes you $1. And so it just seems very different from like a Bitcoin, which is an asset. Now, the existing financial system, as I mentioned before, like it's all trading liabilities. Like the whole payment world is just passing around liabilities. So it does seem like there is something there. But part of me looks like a JPM coin and thinks back, I'm not a great financial historian, but like at one point all the banks issued US dollar notes, right? So you could just go get your Wells note or you could get your B of A note and maybe a bank would go bust and you'd be like, I don't really want the Wells note. And which did not seem to me to be the end goal. Like the end state seemed to be a much more world collapsed around a single currency. So it just seems strange to me that we would end up in a world where like every bank has their own currency that's issued and people are making liquidity between them and you have to understand their financial statements in order to know whether they're good for this IOU that they're handing around.
I mean, you have to ask.
Yeah.
You have to ask what stable coins really do. I mean, there's so many fanciful ideas about what they could do, and a lot of philosophical ethos behind why might some people create them. But ultimately, today they really serve two purposes. The first is in order for you to transact in U.S. dollar outside of Fed wire window times. It's that simple. I want to do something on Saturday afternoon. I need to move dollars now. I can't do that via the Fed. And even I think they're speculating in 4 years' time, you can move $25,000 maybe if the government builds this system, and they may. But that's the first use case. The second one is to give people that otherwise cannot open up a US dollar bank account access to transact in cryptocurrencies denominated in a US dollar trade. That's Tether. I mean, there's Tether, and then there's a bunch of other stuff that's irrelevant. I mean, that's it. Like if you look at the distribution, if you do a nice bubble chart of value, there's Tether, which is, you know, the sun, and then there's a bunch of like little planets so far out that you can't even see them. It's so dim because they're so small. So, and that's not a testament or a statement to whether or not they're good or not. It's just a fact. So, I think that stablecoins are solving two very different problems right now. If you look down the track, if we're going to have cryptocurrencies denominating transactions, stores of value, what have you, then you have to start thinking about real world problems. You know, how would a stablecoin react in a negative interest rate environment, which exists today, right? Go to Switzerland, go to Germany, go to all sorts of places. Well, today I could take my cash out of the bank, right? I could take my fiat, my IOU note, my HSBC issued Hong Kong dollar, whatever it might be, right? I can take that, I can bury it, I can put it somewhere. Although in the US, it's not allowed in most banks for you to store cash. If you have a safety deposit box, you probably haven't read your terms of service, but if you read it, it will tell you you may not store cash in this safety deposit box in this bank vault, where I assume there's cash somewhere as well too. But point in all this being, if it's digitized and there's a negative interest rate, what happens? So now you can't protect yourself, or what mechanism can be created? So I don't think the stablecoin evolution has actually started. What we've created is workarounds for antiquated fiat payment systems, and I'll be polite and use to say workarounds, the word workarounds, for people that otherwise would not be able to access the US dollar. And most people don't speak about it this frankly, but I challenge someone to give me the other real world use case that's been adopted beyond those two. There are other ones, but none of them have relevant adoption.
Well, and I think the real world use case for Tether, is
Yeah.
like, I want to get out of the volatility of Bitcoin and into the volatility of USD, and I want to do it on a venue that won't allow me to store USD.
In a fractional reserve system, apparently, as well.
Exactly.
But anyway.
I mean, like, that's like the primary use case is like, I don't want to hold crypto writ large. I just want to get out of crypto and hold something else. And it's like, okay, well, here's US dollars. I'm not a bank. I can't actually let you hold dollars. So I'll just give
And
you this.
that is the fundamental thing that I think we kind of haven't touched on, is the reason why stablecoin, like who's heard about crypto companies having difficulties getting a bank account? Has that narrative ever, like everyone heard of it? Right, it's impossible basically, until Silvergate basically put the balls on the chopping board and they said, right, we're gonna invest in this, we're gonna make a proper compliance program, and we're gonna be early to the punch. And it actually is similarly to, like, really brilliantly, like Pantera which we're all here today. Thank you for having us, by the way. This has been like an amazing story. If you look at Pantera getting into Bitcoin so much earlier than everyone else, like they are the resident experts because they have got the most experience in this sort of domain because they like did their homework and actually said, no, there's like something very serious here. So congratulations, guys. That's fantastic. But back to this point, the problem is crypto companies can't get a bank account. And people don't want to give anyone a bank account where they're saying, hey, we're going to be huge. We're going to have 100 million users. To a bank, that's the worst possible case scenario. Wait, you're going to have 100 million users that are all sending money and taking money out, and we're left sitting here with a pile of, money laundering risk and no assets under management. And so the idea is stablecoins are actually the first use case for a bank to actually pay attention and give a shit, because they're taking on the risk of the more you scale, the more horrifying you are to a bank, basically. Like Coinbase was at SVB for the longest time, and then they moved off SVB as they started scaling really aggressive, because it's an unwanted risk. If I'm a bank, it's just counterparties on top of other counterparties. If people are using Uber and Airbnb to rent my apartment in the Bahamas for $20,000 a night and paying a 7.5% fee to Airbnb, and that's money laundering, can you imagine how easy it would be to do for an exchange? So if you're a bank, if HSBC is debanking Airbnb and Uber, I'm pretty sure they're not going to want to touch anyone else unless there is a financial incentive to do so. And this vacuum of assets under management, when you digitize liquidity or the asset that can't be digitized, you really do have this exceptional opportunity to gather, just like vacuum clean all the US dollars out of people. Now, the counter to that is it really is a doubling down on yourself, because the moment you open that door, it can flood out just as fast as it can flood in. And anyone with an iPhone on them at the moment or an Android, if you go to CoinMarketCap and you look at GUSD, which is Gemini's dollar, they digitized and it just went straight up. And then as more market participants came, it falls off a cliff really quickly. And that's not to critique them, because I think they're brilliant, but that is the risk that you're undergoing. And the upside being, US Bank now wants to bank USDC because they've got, $800 million in assets under management. That's amazing. If you're a bank, you're like, oh my goodness, this is brilliant. You've got a bunch of regulated counterparties that are all just piling on money into your bank. Sure, we'll give you a bank account. And so I think that, along with the interconnectivity between the Interledger-esque, the interconnectivity of liquidity for traders, where it's sort of a stablecoin exists because the market's volatile, and the market volatility is subsided, the more stablecoins can rebalance across venues to have more accurate price discovery. So there's kind of like, the better a stablecoin does, the more it sort of falls on its own sword.
And I'd slightly disagree on the banking problem. I think that's a little dated. I think if you have an AML KYC program in place and you're registered and you follow the rules, I haven't heard anybody who does those things having a problem getting a bank account. Maybe crypto company needs to be more granularly defined to some extent. But I think for any institution that follow those rules, getting a bank account isn't that hard.
Well, for example, at Barclays, they kicked off a bunch of crypto companies, and the really high-end banks, it does feel like Barclays or Bank of America or Wells Fargo, but
I think that's changing though. I'm not saying it's perfect, but I think it's very popular and easy to simply always state how bad legacy is. It all sucks. We all wouldn't be here if Visa didn't process our airline ticket and the hotel didn't take your card for your incidentals. Like, there are benefits to it. I know you're gonna hate me for this, but there's benefits to this.
I think they've done an exceptional job.
Yeah,
but I think the reality is that the only company in America the only top tier bank that banks any MSB, which is a money services business, which means you're regulated by FinCEN, the federal regulation. That means the only one that does that is Wells Fargo, and Stripe is actually a white label of Wells Fargo.
That's not true. I mean, we're FinCEN regulated, we're MSB regulated, and we bank at BMO. So, I mean, all I'm saying is, I'm not saying it's perfect.
Right, but I mean, I'd probably consider you guys on the exception than going and registering with the other.
So I mean, things like the OCC FinTech Charter are dead on arrival. Like, my point would be that it's changing, it's improving. I think it would really help the conversation in the broader crypto sphere to acknowledge where progress has been made rather than always saying how everything is broken or impossible. I think U.S. Bank's been involved with crypto companies for a better part of 5-6 years actually, so they actually have a pretty good depth of experience in the space. I mean, Silvergate and Signature, it's great that they provide the services they provide. I think we should all kind of hang our heads a little bit and think the best thing we can do is all open up accounts at the same bank to improve flow, and that's back to what does a stable coin do and what have you. So I'm not disagreeing in principle, simply saying, I'm a shiny, happy guy, front-footed.
No. And by the way, please make no mistake, guys. I love my bank, like similar. I use my Fiat, Bank of America, text me, all that stuff. It's fantastic. And they are fighting a very difficult fight, which is, you're fighting against a 24/7 machine with people contributing from all over the world. If you're trying to keep up at best, and I think they've done exceptionally. I was just sort of highlighting the risk tolerance for a bank is now sort of much more peaked. Their interest is much more peaked, and for better. Everyone's got to, they're a business. If they're not making money and they're taking on excessive risk, I understand completely. Last point, sorry for rambling, by the way. What you mentioned before about token economics and all that sort of stuff, it's a bit of a buzzword, but it's actually incredibly important. I'd probably 100x what he said, which was businesses are dead and token economics are going to make everything work. The reason why is because it's a 24/7 economy. Everything is open source. You want as many people to be able to contribute from anywhere, anytime, anyhow, and they cannot do that if it's a business. And so if you're looking at companies in this space, think of it in the mentality, you're not building a business, you are seeding a network. And seeding a network requires liquidity and it requires incentive models. So +1 on that.
And Tom, as we sort of solve some of these banking challenges, I think a lot of people still have trauma from it. I remember chatting with the Bitstamp team, and they started, I think, 7-8 years ago and have been kicked off of how many banks. And now they have a great established banking network. I think they told me they work with over 15 banks. But now we're sort of shifting to still missing infrastructure like settlement and clearing and not having a DTCC in the space. And so, a lot of what Michael is talking about is the basics. It can be hard to get as a crypto company, and that just makes it very hard to operate. Kind of what are you seeing as the next market structure challenge that you would want solved?
Yeah, I think apropos of the comments I made earlier about sort of the way everything's grown up with this massive vertical integration, for us as a regulated exchange and clearinghouse, holding assets and being the buyer to seller to buyer and guaranteeing trades is something that has enabled the growth of the $1 trillion derivatives market. It works. So I think all of us that are in the space providing either exchange services or Tagomi as a broker-dealer connecting to different pools of liquidity, I think there's interconnectivity we can create without creating the DTCC yet again. We don't all have to have one water-cooled mainframe in a basement in Lower Manhattan keeping track of everyone's transactions, right? It's just not what we need to do. So I think that we can utilize technologies, and one day it might be Lightning and what have you, but there's more basic things we can do today to create intermarket connectivity so that the rent seekers that we have in things like consolidating transactions, providing leverage, things that in payments Flex and other folks are trying to take out, I think we can utilize technology in order to remove some of those barriers and let liquidity flow, because collateral management and the movement of liquidity is very, very challenging amongst all these venues today. So that's probably one of the bigger problems we're going to try and tackle in 2020.
What do you think is holding back sort of decentralized exchanges, whether it's decentralized, and this is really for the whole group, but decentralized spot, decentralized derivatives, even decentralized stablecoins? We saw Basis fail. Now we're seeing Cello launch or Celo launch, which will be interesting. Why hasn't decentralized applications come and solved a lot of these issues?
Sorry, I'll jump in there. DEXs, decentralized exchanges. Who gets value from that? You've got to solve it. The thing is, it all comes back just so basic. You've got to solve a problem. Now, whether that problem is for the person in the tall tower or the person, thousands of miles away, it has to resonate. It just happens that you're going to be more successful if you're solving a problem for somebody you understand better. And right now, I think that what happens and what's needed with decentralized exchanges, look at Uniswap. They came and just basically ran over a ton of decentralized exchanges with beautiful products and beautiful brands because the only thing it needs to do is execute and work. Now, is it 10 clicks or 4 clicks? A smart contract doesn't care about that. A smart contract has code that is binary, is yes or no. It has to execute, if otherwise it's not doing its job, and it's programmatically doing its job by being forced to execute under certain conditions. Slippage or no slippage is, a different story, and I feel like thinking about who is the end user, I would think of it as a smart contract as opposed to a trader that's already willing to take counterparty risk.
Awesome. I'll go around and kind of ask you guys, because you're all sort of one of the first to be building what you're building, just what the largest challenges that you face, and if you could get help in one area, what would you like to double down on? So maybe Tyler, I'll start with you in terms of the hardest challenge, especially towards adoption.
Yeah, I think on the adoption side, it's more just projects or cryptocurrencies that are more spendable, so usable as an actual utility. We talked about stable coins and some others that could exist in the medium or near-term future. So those are really interesting to us. So anyone here that knows, reward points or loyalty tokens or crypto that you earn rather than having to buy or invest in, those are very interesting to us right now. And we're also evolving just even our network. This is already going to start to look like, imagine you have your airline app, whatever that is, and you can use those points in your app natively at large retailers and just use them as currency. That's actually what we're moving towards. So when we talk about Bitcoin or other crypto assets right now, that's just a very, very small universe of what ultimately could be used as a digital asset to pay for something in a store online. So for us on the adoption side, that's what's really interesting to us. And then also just more on we've been putting a lot of effort into just the branding and the perception of crypto, just as I just talked about digital assets. A lot of merchants sometimes have this fear of, oh, well, Bitcoin is just used for drugs or whatever it is. And like we now, in trying to really emphasize that, we did even, we opened a physical store at Mall of America with McKinsey. So McKinsey of all entities, hopefully now the premier consulting firm in the world, has now put cryptocurrency in a store in Mall of America, the largest mall in the United States, with all of these retailers now in the mall where you can buy anything with crypto. And we are now using that as like a lab to be able to say, look at what happened here. The efficiency around using crypto to buy something and the cost and the zero fraud and the time and everything else, this is a real thing. And the efficiencies they get out of that. So that has now started to open eyes. We've had a lot of large merchants talk to us about that of, oh, okay, maybe this is something we should really look at.
Yeah, most of this year, when I've been asked sort of what my wish list is, I've been saying, I really wish people newer to the space and regulators would just pause for a moment, get off of crypto news and Twitter and what have you, and do homework. Because you'll find fantastic progress. Like, oh, you need a qualified custodian? There's a bunch of those. Oh, you want a technology solution you can integrate in for custody? There's a ton of those. Oh, you want market data feeds? Plenty of those. Like, all this stuff exists in spades. And I think a lot of folks are just trading off of data and information. I'm not going to take credit for the improvement, but I've noticed a change in the regulatory conversations I've been having. So I would say, talking our book at ErisX, I would very much love to see a stated position on what a digital commodity is. We actually spent a lot of time talking about what is a digital security. What does the SEC think a token is? Well, we're not in the SEC space. We're in the spot commodity space and the CFTC regulated commodities future space. But if we just had a written definition of this is what a digital commodity is, well, we can all use simple mathematical principles to subtract, and we're left with this other stuff that maybe isn't all a digital security, but we know it's not a digital commodity. So I think that's going to become my wish list mantra for the next few months, and I'll cross my fingers with the same success for the homework assignments.
Yeah, regulatory clarity is the single deadliest weapon that an entrepreneur in fintech can have. So I agree 100% in that, that line they need to toe, they know exactly what it is or is not. 2013 FinCEN regulation, what is it, September, October. I bet Coinbase was really happy that it went that way because it slingshotted all the way up to 1,200. What I would say is that, be open-minded. Everyone's got their own beliefs and what they want to see. as a company. We've got what we want to see flourish, but at the end of the day, this is all, it's not about my wants or their wants or their wants or their wants. We are all on a team, and we need to collaborate because you're fighting the heavyweight champion, which is finance. And if this is to improve people for the long term, I think that the collaborative mindset needs to be ground zero. Otherwise, it's sort of a fragmented, nobody's got a chance. So I'd say collaboration, yeah.
Yeah, I would second what Michael said. You know, it's interesting, you actually, Michael, talked about how so much in kind of blockchain and crypto is like building these open networks and being like, you know, having a big tent and inviting a lot of people in. That being said, it's the most tribal sector I've ever worked in, bar none. I mean, like if you're on one project, like you just love it. You just love that one token and there's nothing else matters. And so, you know, that all said, the net market cap of every single token ever is like a Coca-Cola, like the equivalent of one Coke Enterprises. Like it's tiny, 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 tiny. And so for me, I think like not only in terms of collaboration, but I think like one of the reasons that I love and that we've embraced something like Interledger Protocol, which is just an open standard. It's one of the few blockchain projects that doesn't have a token associated with it. It's just, if you want to move value, use open standards. Like embrace open standards. The more we can all work together, that doesn't mean you fight for what you're fighting for, but to Michael's point, like when you try to take down, I mean, like all of crypto is one Visa or one MasterCard. Take your choice. The two of them together is like twice as big as everything going on in crypto today in terms of market cap. And so I think the more that we can actually like embrace open standards and actually have interconnectivity between everything that everybody's doing, and the better we are going to be at actually like changing the world and transforming the financial system and competing with the total global financial system.
Awesome. Well, thank you guys so much for joining. It's pretty obvious that it's really early, and collaboration and clarity are the two big missing pieces. So appreciate you guys coming up.
Thank you.
Thank you.
Yeah. Thanks.